welcome to my channel. I'm nCoachingcentre. So today I'm going to explain your 11th standard accountancy second chapter theory base of account part 2 video. Continue from here last video we start to last page, ending of the first topic of the last page. So let's come to the next topic, that are the accounting equivalence concept. So according to this concept, assets owned by the business must be equal to funds contributed by the businessman in the form of capital. So the assets or the money that are owned by the business should be equal to the fund that are contributed by the businessman for the capital, as the money for investment they had done. So according to this realization concept, according to this concept, income is treated as being earned on the date on which it is realized. So we show you, according to this, income should be written on which date we have earned it. And objective evidence concepts, or it is also called as verifiable objective concepts. These concepts justifies the significance of verifiable documents. It tells us about the verifiable documents supporting us about the various transactions that are done by the company. Next is materiality. This principle emphasizes that only those transactions should be recorded which are material or relevant for the determination of income from the business. Only that things should be written in the accountancy that should be a material or a thing that are giving the income for that business. Next is full disclosure. This concept implies that financial statements should disclose all material information which is required by the proprietor and the other users as the financial account of the business unit. So full disclosure, this concept tells us about the all the material information should be given, which material we have sold and what we have on the money. All the information should be given about the material. Next is consistency. This principle requires the accounting practice, methods, techniques we should use used by a business unit should be consistent. So the methods, techniques, practices what the business unit uses, that should be consistently, it should be used, no changes, or if they make some changes also they should tell it. And a business unit adopt any account practice, and it must be used for a number of years. So if number of years, so the accounting practice, if a business has chosen, it should be continued for years. Next is conservation of prudence. So this principle is nothing but a formal expression of maxim anticipate non-profit and provide for all possible losses. In the other word, it considers all possible losses but ignore all possible profit. So this conservatism or prudence tells us about the all loss which we sometimes we can all profits are ignored and loss are considered sometimes. Next is timeline of information. According information to the management should be supplied in the time and frequently so that the rational decision may be taken. So accounting information should be given informed to the company on time so that they can take the decision what they want. Next is accounting standards. So history and development of accounting standard. The International Accounting Standard Committee that was came into existence in 29 June 1973. So the main objective of International Accounting Standard Committee, that is it short from IASC. They may ask in the final exam what is IASC means. International Accounting Standards Committee that are developed in accounting standard. And in India, the Institute Chartered Accounts of India (ICAI) has constituted the Accounting Standard Board from in the April 1977. Meaning of accounting standards are the rules in written form that ensures the uniformity of accounting standard and provide guidance for the preparation, presentation and reporting of the accounting. So it accounting standard tells about us about the rule guide. It guides us how to write accounts, and it tells us about the importation presentation of the accounts. So features and characteristics and nature of accounting standard are provide guidance to accountings. It brings uniformity. Accounting standards are easily anyone can do, and provide it gives us information. And advantages are it is helpful in bringing the uniformity, help in improving the reliability of financial statement of that company, help for growth of that company, and helpful in resolving the problems. Next, process of accounting. Next is collection and identify financial transaction, recording, classifying. We should summarize it, and you have to write deals and financial transaction what happened, and analyze what you have done, and interpretation, and communicate. You have to communicate it with the manager or higher with your company head. Next, basis of accounting: cash basis of account and accrual basis of account. So the first is cash basis of account. Under this method, only cash transaction are recorded in that book. Next is source document. What is source document? So source document, all financial transactions are recorded in a book of account on the basis of source document or on the basis of some evidence. So every transaction or every money you get means if you sold any product, there will be bill you will make, and on that bill they have paid, you will put and you will write the date accounting. No, without bill you will not pay. So proof it is needed, document proof or something. Next, cash demo. Cash demo is a bill of sale. It is a bill of sale. It is a written document by seller to a purchaser. It is the written document that we have given this much cash is there to have to pay. Next is invoice and bill. So when goods are sold on credit, an invoice or bill is issued on the name of the buyer. So name of the buyer will issue the bill indicating the product and the quantity and the price and services about that product, and about the buyer you will also write. Next is receipt. Receipt is a written acknowledgement that specify the money that is for the product. And pay in slip. Pay in slip is the form that filled when the money is deposited by a customer in the bank account. Draft check, we say no, so like that. A check is the document that order a payment of money. They give order a payment of money. Next is debit note. When we return goods back to the supplier, a debit note is made on the name of the supplier. It means his account is debited. So the money he have given we have to repay. Next, credit note. Then we have to receive the goods back from our consumers. Then a credit note is made on the name of the consumer. It means the account is credited. Next is the types of voucher are there: cash voucher and non-cash voucher. So cash voucher are prepared for cash transaction when cash is received or paid. And there are two types in the cash voucher: debit and credit cash. Debit voucher are prepared only for cash payment. Credit or for opposite side. Debit voucher, credit vouchers are prepared when we receive cash. When they receive cash. Next, meaning of accounting equation. So meaning of the accounting equation is, so assets is equal to, what assets are the liabilities plus capital. So asset or the liability and capital means profit or the loss plus capital we have put, and or capital is equal to the money we have invested is equal to assets minus liability, means the profit we have got and the loss we have loss happened for us. And liability is equal to assets means money profit we have got minus capital we have paid, and assets the loss is equal profit is equal to total liability or total equity, the total liability and total equity assets. Next is total asset is the internal liability plus external liability, means internal losses and external losses what will happen. They are internal expenses, credits, and internal money, and external money are the, we can say. So these are the meaning of equation. Your chapter theory base of accounting. So okay friends, I think you understand this chapter, so I will explain in the next chapter in my next video. Till then, take care. Have a nice day. Bye. Bye, my friends.